Every single day, billions and billions of dollars are flying around in the crypto market. You're staring at the chart, you see those 1-minute candles just spiking up and down, and this powerful thought starts to creep in. I know what you're thinking. Man, if I could just catch 0.5% here and another 0.5% there, throw a little leverage on it, I'd be rich. It's the scalper's dream, right? And the logic, it seems so simple. You see this huge ocean of opportunity, and all you have to do is scoop up a few little drops at a time. But here's the thing. There's a huge, huge problem with that dream. Yeah, here is the cold, hard number that none of those get-rich-quick courses ever want to talk about. 97%. Over a 1-year period, a staggering 97% of retail scalpers, they lose money. That means only 3 people out of 100 are actually profitable. Just 3. That's it. So you gotta ask, right? If 97% of people are losing, where is all that money going? It doesn't just, poof, disappear into thin air. For every loser, there has to be a winner. The money is just being transferred from one pocket to another. The real question is, whose pocket? Well, to figure out where that money is going, you first have to understand the arena you're even playing in. Because when you're scalping as a retail trader, this isn't a fair fight. It's not even close. You are bringing a knife to an absolute nuke fight. Okay, let's just look at the sheer difference in firepower here. On one side, you've got, you, on your home Wi-Fi. On the other side, you've got massive institutions with their servers physically sitting in the same building as the exchange's servers. We're talking co-located. Your trade signal might take, 50 to 100 milliseconds to get there? Theirs? It takes less than 1. It's not even a fair race. Just let that sink in for a second. By the time the price information travels across the internet and hits your screen and you react and click buy, they've already seen it. They've already placed their trade. Heck, they might have already exited their trade. You're not trading in the present. You are literally reacting to information that to them is ancient history. So if you're so massively outgunned, who's holding all the nukes? Well, it's time to meet the players who are actually built to profit from this whole system. There are basically 3 main predators in this scalping jungle, and they are perfectly designed to scoop up all the money that the 97% are losing. All right, first up, we have the market maker. The best way to think about these guys, they're the house. They're the casino. They honestly could not care less if Bitcoin goes to the moon or to zero. All they do is place buy and sell orders at the same time, and they make money on that tiny little price difference in between. That's the spread. And here's the real kicker. You pay fees every time you trade. They actually get paid rebates by the exchange just for trading. It's a built-in structural advantage. Next on our list is the high-frequency trader, the HFT. This is your speed demon. Remember that sub-millisecond speed advantage we just talked about? They use it to see the order book before you do, so they can literally see your buy order coming, jump in front of you, buy the asset themselves, and then sell it right back to you at a slightly higher price, all in the blink of an eye, before your order even gets filled. It's called front running, and it happens constantly. And finally, predator number 3, the hedge fund. This is the whale. And trust me, these guys are not sitting around staring at 5-minute charts. They're playing a completely different game, a macro game. They move the market with their sheer size, using incredibly complex strategies. To them, your little scalp trade, it's just background noise. It's the liquidity they need to fill their own massive position. So at this point, you might be thinking, okay, I get it, but I've got a great strategy. I can beat them. Fair enough. Let's forget about the predators for a second. Let's just look at the cold, hard math of it all. Because the truth is, every single trade you make starts you off in a hole. Think about it. Before you've even had a chance to make a single penny of profit, look at all the costs that get shipped away. You've got the trading fee to get in, the trading fee to get out, you've got slippage, which is when the price moves against you while your order is filling, and of course the spread. You add all that up, and on a pretty typical trade, you are already down 0.3% the very instant you click that button. It's death by 1,000 cuts. And this right here, this just perfectly illustrates the problem. Let's say your goal is to make a tiny 0.5% profit on a trade. Well, because of those costs we just talked about, the market doesn't just need to move 0.5% in your direction. No, it has to move 0.8% just for you to break even and hit your tiny target. You're starting every single race with a massive handicap. And here's something you really have to get your head around. On these super short time frames that scalpers use, most of the price movement isn't a real trend. It's just random noise. It's chaos.
And guess what those HFT algorithms are designed to do? They are designed to hunt for liquidity right in the middle of that chaos. They know exactly where you and thousands of other retail traders put your stop losses, and they are literally programmed to go hunt them down and trigger them.
Okay, so after all that, is it just hopeless? Should you just give up? Absolutely not. But you do need to stop playing their game. You have to stop being the gambler at the table, just trying to guess if the next candle's going to be red or green. It's time to flip the script. It's time to start acting like the casino. And what does that mean? It means adopting something called a market-neutral strategy. Now, that sounds complicated, but it's not. It's just a way of trading where you're trying to make a profit no matter which way the market goes, up, down, or sideways. You take that price risk completely out of the equation. And one of the most common ways to do this is a strategy called funding rate arbitrage. Okay, so how does this actually work? It's way simpler than it sounds. Step 1, you buy, say, $10,000 worth of Bitcoin on the regular spot market. Step 2, at the exact same moment, you go over to the futures market and you short $10,000 worth of Bitcoin. Now, your price risk is zero. You're perfectly hedged. If Bitcoin's price goes up, your spot position makes money, but your futures position loses the same amount. If it goes down, the opposite happens. They cancel each other out. So where's the profit? You get paid something called the funding rate. It's a little fee that, in most market conditions, people who are long pay to people who are short, and it's usually paid out every 8 hours. You're just collecting a fee. And trust me, those little fees, they really start to add up. We're talking about potential returns annualized in the range of 15 to 30%. And the best part, you're doing it with almost no exposure to those wild, crazy price swings in the market. You're not guessing anymore. You're just collecting. You know, this really gets to the heart of it all. The entire market is basically a giant machine. And it's a machine that's designed to do one thing very, very well. Extract wealth from the impatient and the emotional, which is basically the scalper's mindset, and transfer it to the patient and the strategic. So at the end of the day, you have to ask yourself a pretty fundamental question. In this massive crypto game, what role are you going to play? Are you going to be the liquidity that just feeds the system? Are you going to be part of that 97%? Or are you going to change your whole approach and start playing like the house? The choice really is yours.